Hello everybody, welcome back to my channel where we like to talk all things finance and investing. Today's video, I want to talk a little bit about some of the questions I'm getting around the stock market and people getting a little bit wary that we may actually see some sort of a sell-off or worse, maybe even some sort of a crash. Some of the headlines recently have not been positive. Headlines around economic data, tariffs, inflation. There have been a few things here that have gotten people worried, and I'm hearing more questions from clients, colleagues, friends, family about what they should be doing. Should they be reallocating stocks to other markets? Should they just be going to cash instead of stocks at all? A lot of things to kind of tackle, a lot of uncertainty. So I thought we'd address that today in today's video. So let's do that. Okay. So a couple of things. I mean, really, what's been happening? We've had some data out of the U.S. in and around like consumer confidence. The University of Michigan study came in quite a bit worse than expected. We've seen the 10-year yield, which is the U.S. government bonds, the U.S. 10-year yield. It's a bit of a benchmark for what's happening in the economy, but yields have come down quite a bit over the last week at the time of me filming this video. So from around 4.6 down to around 4.1. So a 50 basis point or 0.5% move down. That suggests that a lot of investors are starting to buy bonds, and they're starting to do so because they're getting a bit uncomfortable with the stock market. So they're probably selling down some stocks and moving some of that into bonds and getting a higher allocation to bonds in their portfolio. And that's what people tend to do when they're feeling uncertain or feeling like the market is about to crash. But is that the right thing to do? Is that what you should do? Well, really, a lot of that depends on your risk tolerance. And if you're in the stock market, you should have a pretty good idea of your ability to tolerate risk. Okay. And how comfortable you are. If you're not comfortable with the markets where they are right now, then you may want to consider reducing a little bit of your stock market exposure and maybe doing the same, buying some bonds as well. But that being said, as I've said many times on this channel, stock market is a long-term investing game, really. So when it comes to selling off, trying to time the markets, go to cash because I'm a bit worried, headlines are a bit bad, I tend to be a little bit more in the camp that really you should just tune out all the noise and stick to your asset allocation strategy and stick through that through thick and thin. But I've also read a bit of a report on Vanguard, which I think actually summarized some of the main things you should be thinking about when it comes to times like this, times of uncertainty. And I think it would be pretty useful to go through that because I think that sums it up quite well in my thoughts in terms of uncertainty in the stock market and what you should do. So whether you're just kind of starting off your investment journey or maybe you've been investing for quite a lot of years, you're in your 40s or 50s, have a nice little pot of money somewhere, and you're worried about losing that in a sell-off, I understand the feeling. I understand it completely. So this report should be helpful to you. So let's turn our eyes a little bit onto that and get an idea how they think you should approach times like this of uncertainty. Okay, so this is the report here, the Vanguard. Discipline may be the best defense in a downturn. Yeah, absolutely agree with that. Investing in the stock market has been a prudent long-term strategy for many investors, but market turbulence can be hard to stomach. And we are having a bit of market turbulence right now. Nothing too serious, but we're definitely having some. So looking at the bold here, bear markets are a part of life. Keep a long-term focus. And if you look at this chart that they put in this report here, basically this is going back to 1972, looking at the MSCI World, so world stocks. And what this chart is really showing is, the bear markets are here in gray, these gray bars, and then global shares are marked out on green. So as you can see, bear markets are completely normal. Bear market is generally measured as a fall of 20% or more, which we last saw in 2022. But they can come at any time, okay? But as you can see here, we've seen many along the way, but the whole time, give or take, this stock market has just continued to move up. So the point of this chart is bear markets, market sell-offs, market corrections are all quite normal, okay? But meanwhile, stocks tend to go up over the long term, all right? So that's one thing, okay? Here's another thing that I think is probably the most important bit of this report that I think, and that is timing the market is futile. I couldn't agree more. A lot of investors and traders think that they can actually time the market. They'll sell when it's up, buy back when it's down. But this is notoriously difficult to do. Remember, if you decide to go to cash now or at any time because you're feeling a bit uncertain, it creates other problems. When do you put your money back into the market, right? And so many times in my 20 years of doing this, I've seen headlines that were negative and making you feel like, yeah, maybe it's time to go to cash. But once you do that, now you've got a problem. You're in cash, and when do you get back in? And if you don't time it right, which is typically the case, then you could miss out on some very serious gains. So there's actually a very high risk of trying to time the market by going to cash. The other thing is this report quite rightly shows out is the best and worst trading days tend to happen around the same time. So if you look at this chart here, you've got the gold color and the green color, 9 of the 20 worst trading days and 13 of the 20 best trading days in green, and they all tend to happen at the same time. Okay, if you think back to COVID, some of the biggest down days were then followed up immediately by the biggest up days. And if you miss those big up days, your returns are going to be pretty bad. So it's very difficult to time this right, especially when the best and worst trading days, over a 10-year or 20-year, 30-year period tend to happen within a few days of each other. So it's going to be very difficult to time the market perfectly. In fact, nobody can really do it. Here's another one. Don't panic during the market turmoil. Okay, so investors who sell their investments and switch to cash during stock market downturns have typically underperformed those people who just remain invested through it all and actually just tuned out the noise. And if you look at these 3 circles here, 3 months in cash, 6 months in cash, or 12 months in cash, what you will see is the longer period that you're in cash, the higher probability that you underperform those that remain invested. So if you go to cash for 3 months, then you've got the probability of underperforming a typical 60-40 portfolio, 60% invested in stocks, 40% invested in bonds, 61% chance of underperforming that portfolio. And the median underperformance there is 1.6%. If you go into cash for 6 months, you've got a 72% chance of underperforming a 60-40 portfolio. And if you go 12 months to cash, you've got a 79% chance of underperforming a 60-40 portfolio, with the mean underperformance of 9.1%. So when you look at this, you're basically looking at your odds here of outperforming a standard 60-40 portfolio, and you can't really do it by going to cash. So just bear that in mind. You probably will not be successful by doing that. Okay. So if we scroll down a bit further, so what you can do when volatility hits, and we've not yet seen any sort of extreme volatility, but it may come, and the headlines are getting more scary for sure, and the economic data a little bit as well. But what can you do? So here's a couple of things that you can keep in mind. Number one, tune out the noise. Okay. They say you should never really check your portfolio when the market's down. And I agree with this, because what you're probably going to end up doing is feeling that emotion, seeing your portfolio come down. It's not a good feeling at all. And you're far more likely then to log in and start selling. And that is a very catastrophic move that you would make if you were to do that. So try and tune out the noise. And there is always a lot of noise. Media loves it. Okay. Control what you can on costs. Now, this shouldn't be just the case when the market's volatile. You should always be trying to keep your costs low, because costs over the long term will drastically reduce your returns and the amount of money you have in the future for whatever you're saving for, whether that be retirement or something else. So keep your costs low for sure. Set realistic expectations. Historical return averages are simply that, they're averages. The average will be made up of good and bad years, and that's what investing is. For sure, particularly when it comes to the stock market. You know, if the S&P has returned around 10% on average over many, many years, even decades, but guess what? The cost of getting that 10% return is being able to stomach the market sell-offs. If you can't stomach the market sell-offs, then you should move your money into a bank account, something like that. Get your 4 to 5% a year on average, and you'll have to just be happy with that. But if you're willing and able to maintain your discipline and stomach stock market sell-offs and negative headlines, then the reward will be great. It'll be around 10% a year. for your portfolio, depending on the allocation that you have and things like that. But that's what the S&P 500 has historically returned. But that's the price you got to pay. Market sell-offs and very uncomfortable feelings at times. So stay diversified. That's another way to kind of cushion the blow a little bit. Now, diversification is just balancing out your portfolio between stocks and, say, bonds, because generally speaking, they move in opposite directions. And that has been the purpose of having bonds in your portfolio. Stock market sells off, that's okay. People will shift over to bonds and buy bonds as a safe haven. And generally that works. Although times in stress, it hasn't always worked quite like that. But you can stay diversified. Now, diversification could also mean switching out of stocks in a particular market to another one. So a very popular theme at the moment really is people saying that US stock markets have had such a good run. The US economy has done so well, but Europe has lagged behind. But so far in 2025, European stocks have outperformed the S&P 500. So people are starting to think maybe now's the time to reduce my US stock market exposure and buy some more European. And that is a way that you can diversify if you want to do that. Now, the problem with that is that basically every year you're going to be chasing the hot market and feelings of missing out on a particular market. And it's going to lead you to many different questions about moving your portfolio and trying to chase the next best thing. And it's going to probably lead you to over trading, over movement, paying more in fees, and frankly, a lot more stress and everything. I see this all the time with clients, with colleagues, friends. It's really not worth it. I think you're far better off to following the advice of the likes of Jack Bogle, Warren Buffett. Stay the course, stay invested, stick with your plan and your asset allocation, and do that for the long term. Warren Buffett, I think, is one of the best quotes on this of all time, where he says he recommends investors buy the S&P 500 and buy it through thick and thin, especially thin. And really, I think that's the best advice that you could do. When the market sells off and things are getting jittery, then you just relax, stay disciplined, and add more money into your investment portfolio if you can do that. But it can be painful, no question about it, when the headlines are scary like this, for sure. So that's the Vanguard Report and my thoughts on the markets at the moment and the uncertainty we're facing. I certainly feel like a storm is brewing a little bit. We've also seen some very risk-off moves. Crypto's down below 90,000. Tesla's sold off quite a lot recently. I feel like there's a bit of a storm brewing. Will I then go sell some of my stocks to compensate? Possibly, but probably not, to be fair. I've not really done that before. Sometimes I have, but generally I just kind of stay the course and go with it in and around a 90% stock, 10% cash allocation. There have been times where I've gone up to 15% or even 20% in cash just for peace of mind, and there's certainly nothing wrong with doing that. If you feel it's going to make you sleep better at night, then go for it and do it. But just be aware that it creates another problem. When do you get that 10% back invested in the market? The market tends to snap back a whole lot quicker than people tend to expect. So just bear that in mind and make sure that you don't miss out. So that's my video on the market at the moment, the uncertainties and everything that's going on, potential volatility, potential storm brewing. I hope you liked the video. If you did, leave me a comment. Tell me what you think about the stock market, where you think it's headed over the next few weeks and months, and whether you're going to change your asset allocation. What asset allocation do you have at the moment? And are you going to reduce your stock holding, buy some more Europe or buy some more bonds? Let me know in the comments. Share the video with a friend if you haven't done so already. If you're wondering what I've got on my portfolio and how I invest and you want some more information on that, well, I'll just put a link right up here. There's a video on my one fund portfolio. I'll see you over there. And as always, all the best in your savings and investment journey.